Hello, everyone. Today on the Final Bar, I'll be talking with Sean McLaughlin of StockCharts. We'll talk about some of the charts that he is focusing on Fed Day. We'll debrief on the Fed's big decision to do nothing today, but a lot of discussion about the future and what the future path of interest rate hikes may hold for the markets. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the toolkit of the technical analyst. We'll focus on price, trend, momentum, breadth, sentiment, all the different ways we can try to quantify investor behavior and anticipate what may be coming next. Today, an unusual day, right? We have the Fed meeting. A bit of a question mark of sorts, but at the end of the day, those question marks kind of erased for now, but in a lot of ways sort of pushed down the road a little bit, right? The Fed not changing the target rate today, but all about the discussion of what's called the dot plot, sort of the projected future path of where things may be headed. And I think that is very much a moving target right now. What does the market do on a day like today? Usually pretty quiet beforehand, which is true. That a lot of noise during the release and during the press conference. At the end, one of the financial news outlets that I watch had the power headline, "Stocks Fluctuate Around Fed Meeting." And you know when that's the headline, talk about a non-directional move. At the end of the day, the S&P essentially flat from yesterday's close. A lot of the trends, a lot of the momentum, a lot of the breadth conditions we've been talking about still very much in play. So let's focus on what we would need to see to change that opinion. What would tell us that the trend may be reversed? With that in mind, let's get to our market recap. Let's look at what today's action actually did to some of the charts and major indexes that we track and follow. What happened here? The S&P 500, as I mentioned, choppy day. You can see in the little two-day preview chart, quite a lot of movement. But at the end of the day, we're not too far from where we were yesterday at the close. So at the end, it was all about digesting what we heard, but no significant move. And I think the positive and negative thoughts or comments or reactions in the end netted out to a choppy but directionless day in terms of the overall movement. The S&P finished up just about 0.1% from yesterday, just below 4373. The Nasdaq Composite actually pushed a bit higher, but only about 0.4%, and the Dow was down about 0.7% today. Small caps, the worst performer of this group, down about 1.4%, just below 1,200 for the S&P 600 small cap index. Look at the VIX continuing to go down. So the story of 2023 in terms of volatility has been a slow and steady uptrend when you take a step back and look at the chart on much lower volatility. 2023 volatility-wise does look a lot less like 2022 and 2020, more like 2021. We'll get into the chart of the VIX here a little bit with our guest Sean McLaughlin, so I'll save the rest for that discussion. Let's look elsewhere what happened with interest rates. At the end of the day, the yield curve came down. By the end of the day, a lot of choppiness during the press conference, but by 4 p.m. Eastern, sort of pushing to the downside for rates as bond prices went higher. 10-year yield finishing the day right around 3.8%, and the 30-year yield just below 3.9%. 5-year yield sitting just above 4%. Dollar index down about 0.5%. That's using the UUP ETF. Bit of mixed bag in terms of commodities, particularly oil prices, which went down today by a bit. The energy sector was one of the worst performing sectors out of the 11 today. The rest of the commodity space was higher. Gold prices actually held steady. So this was not like a big move toward offense or toward defense. At the end of the day, it was kind of choppy. And when we look in a moment at the sector leadership, you'll see that very much played out when you think about the sectors and what bets were actually being made during the course of the day today. Cryptocurrencies, for the most part, in the red, but not severe movements. Bitcoin kind of came off through the course of the afternoon here in the equity trading session, just above 25,740, we'll call it, down 0.7%. Ether down 1.4%. from yesterday's close. Just quickly looking at the equity index, or excuse me, the equity sector ETFs and what happened. The technology sector leading the way higher, up 1%. And it's so interesting. You look at some of the leadership names like NVIDIA, they continue to just push higher, right? Onward and ever upward, as we tend to say. And it's interesting. That's not a bad thing that the sector like technology keeps going higher, right? People talk about what's wrong that, mega cap technology is working. My conversation yesterday with Gina Martin Adams of Bloomberg Intelligence was talking about that, right? Is it a bad thing that these stocks are working? Probably not, right? Focus on what indications, what charts will help you recognize when that's no longer working. For today, the technology sector continuing to press the long side. Second, though, was consumer staples. And for much of the day, the XLP was actually the top performing sector. XLK actually overtook it by the end, but staples actually moving higher by about 0.6%, followed by real estate. So number 2 and number 3 today, still up about 0.5, 0.6%, were fairly defensive sectors. At the bottom of the list, you have healthcare and energy, 2 struggling sectors in 2023, 2 sectors that have been chronic underperformers this year. No real change. And if you look at some of the energy stocks, the XLE testing its 200-day, but not getting much above there. A lot of healthcare names actually look fairly weak on a relative basis for sure. And we'll try to get to some of those here as we continue on our market recap. Let's look at a chart of the S&P 500 and just focus on what we learned. After my conversation yesterday with Gina Martin Adams, I added a trend line to the chart with this big green dash on it. I always tell people when I add a big, thick trend line to the chart, be wary. That tells you something important is happening. So here's your PSA. That something important has happened. And all this is doing is looking at a trend line connecting the previous lows. Now, there are 2 different philosophies with something like this. I'm using the intraday low in October and the intraday low in March. Another way to kind of think about this is use the closing prices. And I'm just going to put it on here so you can see how it's not too much different, but you actually take the low close, connect that to the close here. So the trend line would be kind of like this. What's interesting is the trend lines both kind of end up right around the same level right now. So there's not too much of a difference between the 2 of those. But the reason why I added this trend line was if we agree that the trend in the market is up, which if you've not agreed by now, I think you probably should, that the trend from from October of last year to now overall has been positive. Think of this as a trend channel coming off of those lows. Here's your lower end of the trend channel, which means as the trend continues higher, worry less about if we keep making new highs. Worry about pullbacks and making sure they stay within the context of this uptrend, right? As long as these sort of trend lines hold, then the longer term trend is still positive. When a long-term trend like this breaks, that's what tells you things are different. This is why in January, we got a pretty important signal. We finally broke above the trend line, connecting the highs in 2022. Now I'm connecting the lows in the last 8 months or so. Keep an eye on this and see if the price can remain above this on any sort of pullback. So if we do get a pullback over the course, the remainder of this week into next week, look for support potentially at the 50-day moving average, currently around 41.68. The trend line connecting the lows is pretty far down, just below, we'll call it 40.30. So a lot of room, and the reason why I wanted to show this was there's a lot of room for the market to actually pull back, still be within the context of a medium to long-term uptrend, but be just sort of a short-term profit-taking kind of move. And that's the reality of this sort of market that has seen this sort of strength. The S&P's overbought, but there's room to pull back and actually still be a fairly constructive chart over the long term. Briefly talking about breadth here, I was looking at the breadth chart list because breadth conditions have improved, right? And they've been fairly strong recently. And I think, one of the charts that comes to mind is just our basic chart of advanced decline lines. The S&P 500's advanced decline line making a new high for the year here this week, and very, very barely doing so, getting above the February peak. This isn't updated for today's close just yet. And I would assume, based on what we've seen, we'll probably tick just above there, but we'll have to wait and get the official closing data to make sure we line up all of that correctly. But the large cap 80 line actually very close to making a new high for the year, finally breaking above the February high, which is actually very similar to the April high. The rest of these are still pretty far below, but all above their 50-day moving averages. Look to see if we can start to break above their previous highs. And what's interesting is the S&P is already well above its February high, right? That was that 4,200 level. The advanced decline lines have not quite done that yet, but look at what has happened in June with all of these starting to slope to the upside. Another chart I wanted to show was the on-balance volume. We don't talk a lot about OBV, but On-balance volume is basically an indicator created by Joe Granville. The daily volume reading is just kind of choppy and noisy, right? It's sort of a blunt instrument looking at overall volume, and we color code our volume generally on stock charts. So green volume bars were an up close and red volume bars were a down close. If you look at the last week, really the last couple weeks, how you've seen a lot more green bars than red bars, it's because we've had a lot more up closes than down closes. And what happened back here was it was pretty even, right? If you look at February, March, April, kind of even green and red, particularly in May, more down days than up days in a lot of ways. And as a result, the on-balance volume, looking at the overall trend in volume, was fairly sideways. And it's been that way for about 6 months. Look at what's happened, though, in June. You're starting to see more up days on decent volume. And what that's doing is it's causing the on-balance volume reading to improve. That suggests that it's actually an influx of demand, right? That's one of those general, basic measurements of supply and demand, looking at volume changes and measuring it over time using something like on-balance volume. Other indicators are like the accumulation distribution line, Chaikin money flow are all sort of riffing on that idea of looking at volume trends over time. So on-balance volume actually supporting the upswing that we've seen in the S&P here recently over the last couple weeks. Just to finish up, let's look at a couple random names here before we take a break. Starbucks pulling back to its 200-day moving average. And what's interesting is Starbucks sells off, makes a new high at the end of April, looking pretty strong. All of a sudden trades down to the 50-day and breaks below. Danger, right? It's sort of a warning sign and a question mark as to where it finds stability. I always encourage people, look at where we're at right now, look at the final bar and look to the left. What are the key levels that stick out? This is what causes us to think about 97, 96 or so as that support level from March. Obviously, the next important level. As we've come down, we've now found support at the March lows, also at a descending 200-day moving average as the RSI becomes oversold. Watch what happens when we put Fibonacci retracements on here, and you'll see why I like combining some of these different approaches to see when they agree. If we take the May 2022 low, the April 2023 high, 38.2% of the way actually lines up almost perfectly with that March low. That suggests key support here. So what's happening is Starbucks is finding its support at a previous low, at a Fibonacci support level, at a 200-day moving average, all as it's oversold. That is what we call a high probability bounce signal, because all of these different technical approaches calculated very differently, all agreeing that a particular level shows potential promise. Let's take a quick commercial break. We'll be back with today's guest, Sean McLaughlin of StockCharts. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using the power of the StockCharts platform. A couple quick announcements before we bring on today's guest, Sean McLaughlin. Specifically, we would love to hear from you. We welcome your questions about the technical analysis toolkit, about the StockCharts platform, about market history, whatever it is that's on your mind, we are here to help point you in the right direction. Our email is thefinalbar@stockcharts.com. We are on the Twitter at FinalBarSCTV. And if you're watching us on YouTube, just drop a comment below the video you're watching. We would love to hear your questions. Hope to answer one of yours live on the air on Friday's show. I want to bring on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at StockCharts, coming to us from Boulder, Colorado. Sean, great to see you again. How are you?
Hey, it's great to be here. Thanks for having me. I'm doing well. Summer's finally here, although it's been raining a lot. But hey, can't complain.
No sympathy from Redmond, Washington on the rain, Sean, but I appreciate it. I appreciate you joining us for sure. Let's talk about the market overall here. We're looking at the S&P 500 to start. Obviously, Fed Day, a lot of question marks in a lot of investors' minds. But at the end of the day, the market's been pretty resilient, particularly in the month of June. What are you seeing here? How are you making sense of the trend to date?
Well, I'm very pleased with the way the market, the S&P closed the day. It looked like it wanted to give it up, and then we just rallied back towards highs. So I like the way we closed today. But I asked you to bring this chart up real quick because I loved what you were talking about with that trend line off of the October lows. And I'm not disagreeing with you at all. But I do want to point out that the fine folks here at StockCharts like to point out the lows in June, the prior June there. At that point right there where your cursor is, that is when the new 52-week low list peaked. And we haven't, it's been sloping down, not straight line down, of course, but it's been sloping down ever since. And to us, that feels like the more significant date of where the true bear market bottom was. Either way, we're in agreement. This is a bull market, and it's finally time that people are starting to wake up to this fact.
That's a really good point, though, right? And you think about 2022, right? Sort of January through June had a particular look and feel. June through October started to change, right? And the breadth conditions actually started to get not so horrible. And then October, the price starts to rally. But 100% right. And really, I think the contrast is how strong the breadth conditions are here. What's also interesting is the volatility picture. I mentioned in the market recap how the VIX has come down a little bit. When you're looking at volatility, how are you thinking about the low volatility environment today versus 2022? Obviously, extreme volatility. How do you make sense of it here?
Well, David, you've been in this game as long as I have, I believe. And you may remember that for a long time, for most of our career, VIX was kind of the accepted level was 12 was the low end and 20 was the high end. If we were above 20, then, things are getting out of whack. If we're at 12, then, the market's calm. That was kind of the band that we operated in for a long time. So in my mind, I don't take this recent decline in VIX as anything shocking or alarming. I think maybe we're finally getting back to, I hate to use the word normal. There's nothing normal. There is no normal in the stock market. But, COVID is in the rearview mirror. Supply chain issues are in the rearview mirror. It seems like this regional banking crisis is not as crazy as everybody made it out to be. It's still a long way to get figured out. But the fears that have been propping up volatility as measured by the VIX for years now seem to be finally waning, and maybe we're going to get back to the traditional range of 12 to 20 in the VIX.
It is funny. The recent drop seems really unusual if you look at like a 1-year chart. And that's why I brought in a little more history, which I'm glad you wanted to refer to, because if you look at it, we're actually back to a much more normal range for the VIX, right? When you think about volatility now, how do you generally think of it? Right now, we're rallying on low volatility. Is that a good thing? Is that a bad thing? Or is that just more descriptive of the nature of how the markets are trading now?
There's a school of thought out there that says when the VIX makes a new low, then be prepared for the rug pull, right? Be prepared for stocks to hit some slippery for whatever reason. Something happens. Everyone gets spooked because volatility tends to mean revert. Well, I agree with half of that. I agree that when volatility spikes, it is very likely to mean revert and mean revert quickly. But the mean reversion off the low, that could take time as people just kind of come back down to the normal way of things and the fears go away. I would be shocked, David, if we see any sustained moves in VIX above 20 at all for the rest of the year. We may have little pockets where we pop up, but anything sustained like we saw for 2022, that would surprise me. I'll roll with it if it happens, but that would surprise me.
Yeah, and worth remembering, right? When you look at market history, the volatility can get low and stay low, and maybe that's the environment we're looking at here. Let's talk about a leadership name, Apple, right? One of the mega cap sort of FANG names that have been driving this market higher. When you see Apple, testing new all-time highs, pushing to the upper end of the range, what do you see from here? Is it onward and ever upward? How do you think about upside potential in a name that's worked so strongly over the last 6 months?
Look, the world doesn't need another Apple analyst, so I hesitate to throw my hat in the ring on this one, but I feel like Apple is one of those names that people just love to hate. Everyone wants to call the top in this thing. Tesla's a similar stock, right? Everybody wants to call the top, and everybody wants to be a hero selling this thing and getting out at the top. But here's the thing with Apple: there's two very important bogeys out there right now that I have a hard time imagining they don't happen. Number one, everyone's talking about the $3 million market cap. We are getting very close. I don't know the exact number, but I thought I read somewhere that somebody mentioned that if Apple gets to about 191 a share in that neighborhood, that's where it hits the 3 trillion mark. We could get there in an afternoon from where we are right now. That's no trouble at all. And then you throw that $200 strike or level above the market. Look, the market loves round numbers. We talk about the $100 roll over here at StockCharts all the time. Yeah. Well, the $200 roll is the same thing, right? When a stock gets to a big round number, being 100, 200, 300 for the first time, I'm not talking about repeats and back and forth, but when it's an all-time high and it's getting there for the first time, that level just tends to act as a magnet. Everyone's watching it. Stocks as much as we hate to say it, stocks sometimes are just patterns are a self-fulfilling prophecy, right? And I just have a hard time, especially with the way the broader market is acting right now. We were seeing, breadth improving across the board, more stocks participating in this rally. I have a hard time imagining any scenario where Apple does not make a serious run at $200 a share before the end of this summer. So we're bullish Apple. I'm bullish. As an options trader, I bought January 200 strike calls. I'm talking my book here, but I have a hard time seeing that and not seeing that playing out.
I mean, as a trend follower, it's hard to deny the strength in the trend. And I always think that the chart will tell you when the trend's no longer working. And that day is not today for now. Let's go to another sector. We're talking about the financial sector. HSBC is one of the banks I'd love to look at with you. Financials in general have been struggling. HSBC probably one of the stronger names we could look at. What do you like or not like about this particular setup here?
So this is kind of going back to the VIX for a second. You don't need to bring the chart up, but with this implied volatility environment, or this volatility environment where premiums are coming down, options premiums are coming down. One thing that I've been doing a lot of lately is I've been putting on a lot of bullish bets, just simply buying out of the money calls and buying them further dated out in time. I'm a swing trader. My time frame is typically anywhere from 2 to 4 months. But when volatility has been declining the way it has been and options premiums coming down, I've been doing a lot of call buying in January options, going as far out as I can. And HSBC was a very unique situation that we kind of stumbled upon this morning during our analyst meeting as we were looking at this thing and we said, look at this chart. It's trading at 38 and change. The January 40 strike calls were trading at $2 per contract. That's 6 months for this thing to go $3 for us to make money. And here's the thing about HSBC. The word banks right now is a little scary for people, right? What's going on and with Silicon Valley Bank and the regional banks and all that. Rightly so. People are a little skittish when you say the word bank. Well, you could paint HSBC with the same brush that you paint JP Morgan with, right? JP Morgan is a bank that benefited from a deposit flight, right? All these regional banks, people taking the money out and putting it into where can I have it safely stowed? JP Morgan. That's in the US. Well, HSBC is in some ways the international version of that, right? It's a big bank, it's a safe bank, people from all over the world bank with them, and they're benefiting from that tailwind of a flight to safety. And people are afraid of banks right now, but once that fear kind of subsides and people start going through bank stock charts, objectively, this chart to me is going to pop out to people and say, holy moly, look at this. This thing is looking great. And I want to get ahead of that wave. And I, like I said, I'm long. We bought January 40 calls. We paid $2 for them. I feel like that's a steal. I feel like we're stealing money from the market right now. Maybe I'm wrong, but who knows?
There was a lot of technical analysis wisdom in what you just said, Sean. You talked about how people are afraid of the word bank, but the charts are telling you something. I think that's a great illustration of what you think or what you feel is less relevant than what the chart is actually telling you. The setup's pretty constructive here. Sean, can we talk just a little bit about it's Fed Day, of course, Fed Week. There's been a lot of buildup, a lot of anticipation for what we would hear today. At the end of the day, the market kind of netting out to an unchanged day, but a lot of uncertainty going forward. How do you approach a day like today where there's a big potential market-moving news event? Is it sort of a sit on your hands, wait what happens? Do you take calculated bets and just try to quantify the risks effectively? Like, what would you guide people on a day like today and how to make sense of it?
Generally speaking, David, if I'm looking at putting on some swing trades, I don't like putting them on immediately ahead of the Fed event. I'll either wait till the end of the day after the event shakes out, make sure nothing crazy happened, either up or down. And I'll be patient and I'll sit on my hands. And I'm not saying anything that's new here. A lot of people say the same thing. As a day trader, I run a few different strategies in my daily trading, and when it comes to day trades, I definitely play it light. I don't want to I don't want to put on too much exposure. I don't want to have too much open risk. If I do have trades on, I tend to be more delta neutral. Again, I'm speaking options nerd stuff here, but I tend to be more delta neutral, and I try to be long gamma if I can. So that means that if there is a big move, I could benefit from that because I could long gamma my positional kind of adjust as the market goes in my favor. But all things being equal, I tend to keep it pretty light. I don't want to have too much exposure. And a big reason for that, David, is maybe it's embarrassing for me to admit this, but I don't pay attention to the news that much. I try to avoid it. It clouds my mind. It makes me make irrational trades. I think I know more than the people that I'm reading about. No, I don't. I don't know anything. All I know is I know price. So I wait for price to tell me what to do.
I love it, Sean. And it reminds me of what I've heard from a lot of successful investors, like know your strengths and find ways to benefit from that. It certainly seems like you've been able to do so with charts and the options market. Sean, awesome to hear from you. Great to see you. Please give our best to JC and Steve and the All-Star Charts crew, and we'll talk to you again soon.
We had a great time hanging out with you in New York a couple months ago. Great to see you, Dave.
Good to see you too, Sean. That's Sean McLaughlin. Sean's the chief options strategist at All-Star Charts, coming to us from Boulder, Colorado. I just can't stress enough how I love that take, right? Thinking about banks and, the reason, don't ever let the reason why you don't take a trade because you're afraid of it or just because of this feeling that you get because of what if this doesn't work or is this really the right time? Focus on what the charts are telling you. Charts are fact. Price is fact. Your feelings are opinions. What's happening in the market is factual. Focus on that. That was great investment wisdom and some really interesting trade ideas from Sean McLaughlin at All-Star Charts. We've got to wrap the show, folks, and go to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. The XLK, we're talking about the technology sector, the top performing sector today. I always like to look to the left, as I mentioned many times. Look at the final bar, look at the current bar, look to the left, see where we're at relative to where we've been. What's interesting about the XLK is we are at all-time highs. We're kind of there. Now, a lot of individual names are sort of facing this same issue. Talked with Sean McLaughlin about Apple, Microsoft, others are all sort of in that similar boat. So what do we do now? Well, I would say just the simple fact that we're at the previous high, to me, is not enough. That tells you be ready for some sort of movement. But look at what actually happened at the 2021 high. Number one, we had a bearish momentum divergence, higher highs in price, lower peaks in the RSI, lower peaks in the PPO or the MACD indicator. All of those started to suggest on those last highs that the momentum was waning. We have not seen that yet. We're actually seeing the momentum remain fairly strong. So what it tells me is to look back, recognize what often happens at a market top. These signs of exhaustion, look for similar signs of exhaustion now. What I would be wary of is if we keep making new highs and the momentum starts to rotate lower. We make new highs and the PPO indicator starts to give a sell signal. That is when I will start to make a lot of noise about skepticism of further upside. Chart number 2, within the healthcare sector, Boston Scientific, BSX. When we're thinking about the healthcare sector, it's been a tough place to be. BSX actually gapped higher today, up about 4%. While much of the sector has been languishing. The reason why I would have mentioned this, I mentioned a potential potential bearish momentum divergence for the S&P 500. Look at what we're actually seeing right now over the last couple months for BSX. This is an example of how that actually plays out. Higher highs in price April to May, lower peaks in momentum April through May as well. It's pulled back, but now we gapped higher. Now we're gapping up to that level where we've seen previous exhaustion in that bullish scenario. I would be wary of further upside. A push above 54 on stronger momentum starts to make this a much more constructive chart. For now, I would be more skeptical of upside potential because of the previous exhaustion signal. Finally, we talked about the breadth conditions. Again, what do you do in an environment like this? I would argue follow the trends, right? The charts will tell you when the trend is no longer working. One of the indicators I'll be watching is the bullish percent index on the NASDAQ 100. Look at what has happened previously over the last 12 months when we've gone above 70%, which means most stocks in a bullish point and figure phase, and then it rotates lower. Those have been significant tops over the last 12 months. We're not there yet, but this might be the chart to watch. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. All of our previous interviews can be found on our YouTube channel. Thanks to Sean McLaughlin of All-Star Charts joining us from Colorado. I'm Dave Keller with Stock Charts. Have a great night.